Hey there, fabulous financiers. Welcome back to the Do Different Better show, where we talk about wealth wisdom and making money moves and finance simple for everyday people. I'm your host, Elaine Rasmussen, founder and CEO of Social Impact Now, Connective Institute, and managing director of the Integrated Capital Fund. Thank you for joining me today. In our last episode, we talked about the exciting world of real estate investing. Whether you're a first-time investor or you're looking to expand your portfolio, I broke down the basics of real estate investing. We covered different types of properties, key concepts like rental income, appreciation, and cash flow. I also shared some of my own investing mistakes and common pitfalls in real estate investing. And then finally, I gave you some practical and tactical tips for being successful. But today, we're going to break down the basics of the stock market to help you kickstart your investing journey with confidence. In this beginner-friendly episode, I'll cover the basics of the stock market, what stocks are, how the stock market functions, and get an overview of some major stock exchanges. You'll discover why investing in stocks is a great way to grow your wealth over time. I'll discuss historical returns, dividends, and capital gains, but also some more practical tips on setting financial goals, opening a brokerage account, as well as how important it is to regularly check your portfolio and make adjustments as needed. And I'll also share some really good resources like books and websites to keep you informed and keep you savvy. But let's jump into the basics of the stock market. Once again, if you're new to investing and you're curious about the stock market and how it works, this is a great segment for you. So let's get to it. So what is the stock market? The stock market is where investors buy and sell publicly traded companies. Think of like a farmer's market or a Turkish bazaar. The stock market is a big part of the economy. The stock market allows companies to raise capital and investors to grow their own personal wealth. But what exactly is a stock, and how does the stock market function? So first, let's talk about a stock. A stock represents ownership in a company. When you buy a share of a company's stock, you're purchasing a small piece of that company. Stocks are also known as equities or public equities. And the reason why they're called public equities is just like the name implies, they are available to the public to purchase. Now, you can buy one stock or you can buy 100,000 stocks. Usually, companies will have a specific number of stocks that are available to purchase, but as long as your resources allow you, you can buy as many individual pieces of stock of one company as you would like. Then there is the stock exchange. Stocks are bought and sold on exchanges. The two most popular ones you may have heard of in the United States are the New York Stock Exchange or NASDAQ. NASDAQ stands for National Association of Securities Dealers Automated Quotations. You can see why they call it NASDAQ for short. That's a lot of words. Many countries have their own stock exchanges like Kenya, Ghana, Zimbabwe, Japan, Hong Kong, Bombay, London, Toronto, just to name a few. These exchanges offer stocks for publicly traded companies in that country. So the U.S. Stock Exchange is going to have companies that are U.S. companies and vice versa with other countries. But the New York Stock Exchange is located in New York as well as NASDAQ. But New York Stock Exchange is one of the oldest and largest stock exchanges in the world. NASDAQ, on the other hand, is really known for its high-tech listings and electronic trading system. So you're going to see a lot more tech companies on NASDAQ than you will see on the New York Stock Exchange. Understanding the basic structure of the stock exchange where stocks are traded is the first step to becoming a really savvy investor. Now let's move on to how the stock market actually works. The stock market operates through a network of exchanges where stocks are listed and traded. Prices are typically determined by supply and demand. So the more people want that stock, typically the higher the price is going to go. And as people stop trading or trading slows down for that stock, you'll start to see the stock price goes down. There's a couple of ways that this happens. So there's brokers and online trading platforms. Investors buy and sell stocks through brokers or online trading platforms. Brokers act as, just like the name sounds, they act as intermediaries between buyers and sellers, facilitating these transactions. So you would be an individual, you might work with a broker who buys and sells on your behalf. There are some examples like E-Trade, Robinhood, and TD Ameritrade that allow investors to trade stocks online with just the simple click of the button. Then there are also stock market indices. Stock market indices trade the performance of a group of stocks to give a snapshot of an overall market performance. There are well-known indices like the Dow Jones Industrial Average, the S&P 500, and the NASDAQ Composite, which is different than NASDAQ, right? The NASDAQ Composite. You might have heard the word index, and indices is just the plural of index. So you'll hear me talk about indexes, but what I'm talking about are things like the S&P 500 and the Dow Jones Industrial Average. So just a little bit of breakdown. The Dow Jones Industrial Average is comprised of 30 large publicly owned companies based in the United States. And just like the name sounds, it's looking at the average of these 30 companies, what's happening. And you might hear, on the news, or you might hear if you're listening to Bloomberg, oh, the Dow Jones is up or the Dow Jones is down, right? They're just looking at the average of these particular 30 publicly traded stocks. Then there's the S&P 500, which includes 500 of the largest companies listed on a stock exchange, on the U.S. stock exchange. So that S&P 500, the top 500 companies, because there's thousands of listings on the New York Stock Exchange, the top 500 are what's called the S&P 500. And as you can imagine, that shifts and changes who gets on that list over time based on how well or how not so well a stock is doing. Then there's the NASDAQ Composite, which includes 3,000 stocks, but once again, they're mostly in the tech sector. So this is really important because if you're looking at the NASDAQ, but you're really interested in investing in healthcare or you're really invested in construction, looking at the NASDAQ Composite isn't going to be a good list for you to look at as far as understanding what might be happening in the market, because those stocks don't represent the industries that you're looking at. Now, where you might want to see where do these things line up, if you're interested in healthcare, you may want to understand what's happening with healthcare technology. So looking at the NASDAQ Composite from that perspective could be really helpful in giving you some insight as to how the healthcare industry might be doing, understanding that healthcare tech is a component of the healthcare industry. But these indexes or indices help investors understand market trends, compare their performance of their investments to the market as a whole. And there are several ways to actually trade an international stock if that's what you're interested in, but we're going to save that for another episode. Today, I'm just going to talk about the most common ways, which is exchange-traded funds, but more on that later in the show. Now let's discuss what different types of stock you might encounter. So there are different types of stocks, and each one has its own characteristics. Understanding these can help you make informed decisions. So first, there's common stocks versus preferred stocks. Common stocks are the most typical type of stock that investors buy. They, once again, represent ownership in a company and entitle a shareholder to a vote at the shareholders' meetings, and they receive dividends, which are payouts on an annual basis based on how well the company performed that year. When you buy a common stock, you can get one vote per share to elect board members and decide on other matters. Preferred stocks, on the other hand, while they also represent ownership, they typically do not come with voting rights. However, they do have a higher claim on assets and earnings than common stock. So where you see that really come to light is if the company is going into bankruptcy, if the company is closing its doors, or other sorts of events where the company might need to restructure. However, but preferred stocks do receive dividends before common stock shareholders, but it's often at a fixed rate as opposed to a rate adjusting based on the agreements that are outlined in your common stock purchase price. So then there's growth stocks and value stocks. So growth stocks are shares in a company that are expected to grow at an above average rate of other companies. These companies usually reinvest the earnings to expand and grow, so they don't pay out dividends. We see this a lot with startups, especially technology startups or companies that are doing something really innovative in a particular sector, but especially the tech sector. So an example would be like Amazon or Tesla are often considered growth stocks because they focus on expanding and capturing market share versus prioritizing paying dividends to the shareholders. However, the shareholders still want to make sure that the shareholder price is at a good price, right? That is securing their investment. Then there's value stocks. And value stocks are shares in a company that are considered undervalued in price and trade for less than their intrinsic value. Investors in value stock look for stocks that they believe the market is undervalued. So there are companies like Johnson & Johnson or Procter & Gamble. These are what are called consumer packaged goods. And they might be seen as valuable stocks offering steady dividends and trading at lower price multiples, meaning that they're trading at a lower price, but it's more consistent and more reliable as opposed to the ups and downs of like a Tesla or an Amazon. Knowing the difference between these types of stocks can really help you build a diversified portfolio that balances your risk of potentially losing money, but the reward of gaining dividends or increased stock price and stock shares and stock value. So that's it for this segment on the basic of the stock market. What we've covered today in this segment are how the stock market works, what kinds of different stocks are there, and we're going to talk about in the next segment, we're going to go deeper into investing in stocks and how they are a really great way to grow your wealth. And we're also going to talk about how to get started. So stay tuned and I will show you how to do different better. Hey there, fabulous listeners. Welcome back to the Do Different Better show. I'm your host, Elaine Rasmussen. And if you're just joining us, in the last segment, I shared the basics of the stock market. If you're new to investing or you're just curious about how the stock market works, it was a great segment. I encourage you to go back and listen to it. And in this next coming up segment, we're going to be diving into how to invest in the stock market, whether you're a newbie or you're just looking for some solid advice to augment what you already know. This is going to be a great segment for you. So let's get started. So why invest in stocks? Investing in stocks is a great way to grow wealth over time. You may have heard me talk about this in previous shows that on average, the stock market has only gone up over time. But what should you actually consider when you're doing it? So let's break it down. So first of all, there's historical returns. Historically, the stock market has provided higher returns than other types of investments like bonds and savings account. If we look at let me just say, I have two thoughts coming through my head. Over the long term, the average annual return on the stock market has been around 7 to 12%. And that's pretty impressive, right? When you think about a savings account, even before our current sort of financial situation, a savings account was paying out maybe 1, maybe 2, maybe 3%. So when you're thinking about a long-term investment strategy, 7 to 10% year over year, that's great. And you compound that every single year. It's a phenomenal amount of money in a relatively short period of time, right? So just a fun fact. If you had invested $1 in the stock market And there are what are called penny stocks where you can buy them and they're usually under $1. There's lots of stocks that are under 10 and 15 and $20. So there are some affordable ways to get into the market. But if you, just for an example, if you had invested $1 in the stock market 100 years ago, now none of us are 100, there's very few of us that are 100 years old, but stick with me in this example. But if you stuck $1 into the stock market 100 years ago, it would be worth $14,000 today. That's the power of compounding returns. So let's say from $1 that in 1 year you generated a $2. Well, the next time your return is going to be on $2, not on $1. And so that just exponentially grows year over year over year. So as I was mentioning before, if we look at the lifespan of the stock market, while there have been ups and downs through different kinds of economic situations, we've come out of an economic pandemic. The stock market on average, though, has always trended up. So part of the thing is, can you withstand the pain of a down market? Or you want to be looking for when the down market might be coming so you can make adjustments in your portfolio. We'll talk a little bit about that, right? So the second thing is our dividends and capital gains. There are two ways you can make money from stocks. Those are from dividends or from capital gains. Dividends these are the payments that are made to you or the stockholder by the company, right? These are the payments that they make to the shareholders, usually on a quarterly or annual basis. And it's like a little bonus just for owning the stock. You're going to get a piece of the profits. A piece of the profits go back into the company, maybe for research and development, maybe for a rainy day fund, but also a portion of that goes back to all of the shareholders or the people who own stock. Capital gains, this is the profit that you make when you sell a stock for more than what you paid. So for example, if you bought a stock for $50 and you sold it for $100, then you would have a capital gain of $50. Now, here's something that's important to know. When you have a capital gain, there is a tax implication for your capital gain. So a lot of times if somebody sells a stock, they usually have a plan of what to do with those profits so that they can lower their tax liability or lower the amount of taxes they'll have to pay, because every dollar that you make, Uncle Sam wants a piece of it. So that includes your investments. So once again, this is where you might want to employ working with an investment advisor or joining an investment club, right? We talked about investment clubs a couple of episodes ago. So you can be aware of what are some of the tips and tricks that other folks use as they build a strategy when they decide to sell a stock, particularly if that stock has some significant capital gains. $50 capital gain probably isn't that big of a deal. But if you're talking about $20,000, $30,000, $40,000, that is now, think about that as additional income, and you're going to be taxed on that. But all in all, investing in stock allows you to benefit from both the growth of the company and the income that it generates. So now let's talk about how to get started. Getting started in the stock market is actually easier than you think, but there are some things I really want you to consider before you get started. One is setting a financial goal. First, determine why you even want to invest and what do you hope to achieve. You may be hearing a theme here, right? Are you saving for college? Are you planning for a down payment on a house? Or maybe it's retirement, or maybe it's an upcoming medical procedure or some other familial event. But setting clear goals can help you stay focused and motivated and not emotional, right? Sometimes we get emotional, we get so excited, and so we lose sight of, hey, what did I actually want this money to do? How did I want to activate it? I remember when I started investing with some friends of mine in cryptocurrency and having a conversation about, okay, is there a point where we take the money out, right? Do we want to double our money and then take our money out? Do we want to triple our money and take our money out? Whatever the situation is, having it clear and writing it down, because you're not going to remember. I promise you, you're not going to remember. So write it down, maybe put it on the refrigerator, maybe put it on your desk, your at-home desk in your office, whatever that is, but make sure that you're clear. So here's an example. If you want to save for a new car in 5 years, you can set a specific target amount and figure out how much you need to invest each month to reach that goal, right? Whether that's in one stock or a collaboration of stocks, whatever that looks like, right? But you're making a plan, you're working the plan and making sure that you achieve the plan. The second thing that you can do, that you need to do, is to open a brokerage account. Once again, this is if you're going to do it on your own. I always suggest, if you're able to and you have the resources is to work with a professional, but there are plenty of people who do this on their own. There's lots of videos, but once again, many of those folks that are doing these videos are not professionals. They are not investment advisors. So just take in that information carefully, mindfully, double check it, triple check it. If you've got a friend or a friend of a friend, you can run some of the things that you've heard or you've learned, run it by them. But once again, joining an investment club and learning from people who've already done this is another great way. But back to brokerage accounts. This is an account that allows you to buy and sell stocks. There are lots of online brokers to choose from, like Charles Schwab, Robinhood, E-Trade, and TD Ameritrade. There's hundreds of them out there. Some of them are regional based, some of them are national or global, so you should be able to find something that meets your needs. And here are a couple of steps. So research a few different brokers to find one that's going to fit your needs. There's usually an online application. Fill out that application, and you need to know that you're going to need to provide some personal information and some financial details. Then the third thing is you want to fund your account by transferring money into the bank, from your bank account. So typically in the online application, they'll ask you, who do you bank with? And they'll ask for your banking information. So as your account fluctuates and rises and falls, that they're going to have access to your bank account to, if you start to go below a certain point, that they have permission to take money, a certain amount of money out to relieve your portfolio. And then the last thing is you just start trading. You can buy your first stock with literally just a few clicks. It's really that simple, but with your goals set and your account open, you're ready to start investing. But what's the best strategy for beginners? So let's get into it. There are some great strategies for beginner stock investors, and I hope that these tips will help you get onto the right foot. So the first one is dollar cost averaging. Dollar cost averaging involves investing a fixed amount of money at a regular interval, regardless of the stock price. The strategy reduces the impact of market volatility because you're buying more shares when prices are low and fewer when prices are high. So for example, if you invest $100 every month, sometimes you'll buy more shares if the price is lower and a few shares if the price is higher, but over time, this evens out the cost of what you pay for your investment. The second way to do this is by diversification. Diversification means that you're going to spread your investments across different stocks and sectors to manage the fluctuations or risk of losing money. It's not in this kind of a strategy, you don't put all your eggs in one basket. By diversifying, you reduce the impact of poor performing stocks on your overall portfolio. So here's a tip. Consider investing in an index fund or an exchange traded fund that track a broad market of indexes like the S&P 500. These funds give you exposure to hundreds of stocks, therefore making diversification easy. The diversification is really built in, right? So by using these strategies like dollar cost averaging or diversification, you can build a balanced and resilient investment portfolio. Just remember that investing is like a marathon. It's not a sprint. So you really want to stay patient and keep learning. And once again, do it in a group. Find some other folks that you can do this with, whether we talked about real estate investing clubs. There are also stock investment clubs that you can join. So look for those in your community online. Look at your local librarian. A lot of times they are a good resource. Where are some good places to find information, particularly historical information about trades? There's also a great simulator. So Investopedia, and there are others online. I think this is a really great place to start, is to just really simulating, starting with the simulation and then going from there into real stocks. So maybe over a 3-month period, you can start to think about working in sort of a simulator and to dip your toe in the water, and then using that as an opportunity to be able to figure out how are you going to manage this. And I'll talk a little bit more about this in the next segment. But once again, investing in the stock market is a marathon. When you're investing in the stock market, it is typically you're looking at investing for a longer period of time. So I would say definitely a year or more. This isn't about, now there are people who you may have heard, they're called day traders. They're just trading on the day. They're looking for quick wins throughout the day or for that particular day. But if you're new, that is not the place that I recommend that you start, right? I think taking a more measured approach until you really have some understanding about your risk tolerance. What are you willing to do? What are you not willing to do? But also, what are you willing to lose and what are you not willing to lose? And what is attractive to you? And start to build up an investment strategy. So stay patient and keep learning. That's it for this segment on investing in the stock market. We've covered why you should invest, how to get started, and some really beginner-friendly strategies. Stay with us in the next segment. I will give you some practical tips and resources to help you manage your investments. So stay tuned, and I'll show you how to do different better. Hey, fabulous financiers. Welcome back to the Do Different Better show. I'm your host, Elaine Rasmussen. And if you missed it, we have just been talking about why you should invest, how to get started investing in the stock market, and some beginner-friendly strategies. In this final segment of this episode on the stock market, I'm going to cover some practical tips and resources. This is when we're going to get down into the nitty-gritty of monitoring and managing your investments. Plus, I'll share some really great, awesome resources to keep you on top of your game. So let's get to it. So we're going to talk about monitoring and managing your investments. So we've gotten ourselves going and you've started investing. That's amazing. Congratulations. But the work doesn't stop there. Once you start investing, it's important to monitor and manage your investments regularly, right? Just like going to the gym. Just because you start going to the gym doesn't mean like your body's just going to like fall into shape. You got to keep going. You got to keep maintaining, which is sometimes the hardest part. But here's some options or some ways that you can do that. The first one is doing regular reviews. You should be checking your portfolio periodically to ensure that it aligns with your goals. Think of it as a health checkup, but for your money. So example, set a reminder or a meeting invite. I put everything on my calendar. I live by my calendar. Even my personal things, I have a personal calendar, and my personal calendar, my work calendar are congealed onto my phone. So I always know kind of what I'm supposed to be doing at any given moment in time. It actually helps reduce the level of thinking I have to do. It's amazing. But you definitely want to be, put it, it's really great to put it on your calendar and just set up some time. Maybe it's Sunday morning, right? The stock market is closed. There's not much going on. You're having your morning coffee or after you've done your yoga. Maybe not after you're done your yoga. It might stress you out. But the whole idea is that you have a regular cadence, whether that's weekly, whether that's monthly. Certainly when you're starting, you probably want it to be a little bit more frequent. And then as you get more comfortable and you're kind of, you're not trading as often, or you're kind of passively investing, you could go maybe a little bit longer. Maybe it's every other month, or you're just checking it every quarter. But definitely you want to take a look at it regularly. No different than your car. You have your tires checked. You have the oil checked. This is no different. Managing your money is no different, right? So when you set that meeting reminder to review your investments on a monthly basis, look at how each stock is performing or index they're performing. You might even want to make yourself a checklist. Hey, I'm going to check these indices. I'm going to check these stocks. And I'm going to start researching new opportunities, right? Maybe those are the 3 things you do in that 30 minutes that you've dedicated to evaluating your portfolio. But then this is an opportunity also for you to check to see if you're on track to meet your financial goals. You can make some notes or any concerns or questions that you might have, right? The questions you can then bring to, once again, a professional, or if you're part of an online community, you can bring the question to the community. Once again, doing this with a friend or your partner makes it a lot more fun and more likely that you're actually going to do it. I know for me, I love an accountability buddy. Having an accountability is just going to make sure that I actually follow through, because I don't want to look like the idiot who didn't do what I said I was going to do. So the second thing is adjusting your strategy and being mindful that, once again, this is not a sprint, it's a marathon. Changes might need to happen, and quite frankly, just will need to happen. As life happens, your financial situation and your goals might change. Maybe you get a promotion, maybe you're planning to have a baby, or you're having a baby, or maybe you're deciding to save for a new house or a real estate investment like we talked about. It's important to adjust your investment strategy accordingly. And so what do we mean by that? What that means is, maybe when you started, you were more willing to take more risk, right? You were more willing to invest a lot more money and making huge bets on a particular stock or a particular fund. But as your life changes and you might need some security, you might not make the same bets that you were making before when you were single, right? When you get in a lifetime relationship, you may want to not be so aggressive with your investing strategy. So a lot of times you might hear a wealth advisor or investment advisors ask you, do you find yourself aggressive or do you find yourself conservative? And there's scales all in between that, from aggressive investing, which meaning like you're going to make some big bets, with the hope of some high returns, versus conservative. I'd rather have slow and steady wins the race investment returns. They're going to be reliable, that pay over time and are consistent, more consistent and more persistent, as opposed to the fluctuations of a highly aggressive market. And once again, that is a spectrum. And so you want to start to understand, how aggressive are you or how conservative are you? There's no right and there's no wrong answer, but you do need to know. So as you're looking and making bets, there's actually indicators on some of these stocks that say, oh, this is an aggressive stock. This stock is expected to pay out high, but you might have to wait a while before that big jump in the stock price for that big payout. So these are all the things that when we talk about adjusting your strategy, it's really about moving from on the pendulum of aggressive to conservative. And at different points of your life, you're going to feel the push and pull to move in one direction or the other. Typically what we see is younger people tend to be more aggressive. And the reason for that is the implication is that, or the assumption is that they have time to make up for any losses that they have. And as you get older, you become more conservative because you have less time to make up any losses that you may have. So those are just some of the underlying thoughts about what we talk about when we say your investing strategy. We're talking about how assertive or how aggressive or how willing, what are the bets that you're willing to make and what are the bets you're not willing to make. When you think about whether that's investing in stock market, investing in the real estate, or investing in other things that we'll talk about in future episodes, like investing in private companies. But keeping a close eye on your investments and being ready to make an adaptation to your strategy is super, super crucial for long-term success. So now let's talk about where you can learn more and keep growing as an investor. So as we've talked about with everything on our show, continuous learning is key to being successful, no matter what it is that you decide to do, whether, once again, cryptocurrency, real estate, stocks, bonds, which we'll talk about in the next episode. You've got to be continuously learning, right? And being willing to continuously flex and shift as your life needs change. But the more you know, the better decisions you'll make that are going to be best for you, right? And that's another thing that's really critical to understand. While you may participate in an investment club While you may have a friend that you're going on this journey with, their life circumstances and your life circumstances are not the same. So when you're having these conversations with your investment club or friends, understand that they're making their decisions and they're talking about their investment options from the lens of their personal goals. They may not say that, but that's what's happening. We come to every conversation with our own personal lens. This is no different. So you just want to listen for that when you're listening to maybe advice that you're getting. Maybe it's a tip that you've heard or a strategy that somebody you know is using. They're using a very aggressive strategy. Is that right for you and the goals that you've set up for yourself? And being mindful of that will help you make sure that you don't make any rash decisions that could have some serious financial implications. But once again, we've talked about continuous learning is really important to your successful investing journey. So here are some resources that will help you out, right? So there's books and there are courses, right? There are many great books and online courses out there for beginners and for folks that are maybe a little bit further along. Maybe you've invested in a fund, maybe you inherited some stocks, and so you've been owning them, but you really haven't been actively participating in understanding what they are, how they work, what the stock maybe is. But here are some great recommendations, right? The Intelligent Investor, I think we've talked about that before, by Benjamin Graham, A Random Walk Down Wall Street by Burton Malkiel, and Broke Millionaires Take on Investing by Aaron Lowry. So these are really great books that really kind of help you understand what's going on. Another great resource is I'm a big fan of Susie Orman. She's really great as far as thinking about particularly looking at retirement funds and how to leverage those investments. But there's lots of great information. There's the Budgetnista. I don't think she talks about stocks or anything, but really understanding personal goal setting as it relates to your financial journey. She's an amazing, amazing podcaster and YouTuber to get information. And she really talked about it from her own experience. So I definitely encourage you to check that out. But also there's some really great websites like Coursera. There's Udemy and there's Khan Academy, Khan, that offers some really great courses on investing basics. There are some states, I know in Minnesota, for a while, we were offering free access to Coursera. So you might want to check your particular state, particularly I think if you will go to your economic development department or the career development programs that are in your state, see if they have a partnership with any online universities or the local universities. They may be offering these courses through your local university for free. So there's some great options out there that are highly accessible. Go to the reference librarian. They will also be able to tell you if there are courses that are available either through the library, through the subscriptions that they have. Maybe they have a Coursera subscription or a LinkedIn Learning subscription that you can have access to, or you can start to take courses on understanding and investing in the stock market or just investing in general. But once again, many of these resources are free or very, very affordable, right, for any income level. The second thing that resource are financial news and websites. And I get it. It can be overwhelming. But once again, staying informed is such a big part of being a savvy investor. So following reliable financial news sources, not entertainment news sources. And many entertainment news sources are masquerading as actual news, and they are entertainment channels, right? So just be mindful of that. But you want to look for a news source that is a financial, reliable news source that keeps up on market trends without opinions, right? And to get expert analysis. Now, some channels, there's like CNBC, there's Bloomberg that offers daily updates. They have, and there are other kinds of websites like Investopedia where you can go in-depth articles and tutorials on things. But all of these are resources that can really help you understand some of these topics in a very, very simple way. But really wanting to go back to like Bloomberg and CNBC, and those aren't the only ones. I'm a big fan of the Bloomberg channel. What I love about the Bloomberg channel is I'll turn it on like at 6 in the morning. You only need to watch it for like 20, 30 minutes and you kind of get an overview of like what's happening in the market. After that, a lot of stuff just repeats, right? Or they're asking people's opinions on different things, or they're giving their different perspectives. And that's fine. But what you want is you want a reliable financial channel that separates the opinion from the actual market information. So as long as you have like, here's the data, here's the market information of what's happening in the market, and then they very intentionally and very transparently say that they are switching to the opinion portion of the show. So that's what I mean by just making sure that you're following a channel that is a reliable financial news source. And typically you'll see the data on the screen. But what I love about Bloomberg is usually on the side, on the left-hand side of the screen, they'll give you updates. One, they'll give you updates on like what's going to be coming up on the show, but they're also giving you market updates. So it gives you this way to just, even if you only have 10 minutes, you can watch the channel for 10 minutes, kind of see what's going on in the market. And then you can think about, well, do these things have implications for the stocks that I'm invested in? So I'll give you a really brief example. So, if let's say you're invested in construction and you are watching Bloomberg and you see that the price for timber goes up and they're foreseeing that the price of timber goes up it's going to be going up for a substantial amount and the price isn't anticipated going down anytime soon. Well, if you're invested in construction, that is a market that's going to have implications for your investments in construction. So these are where you want to start to think about how is what's going on in the world might impact the things that you're investing in. Because if you're investing in construction, in anything in construction that relies on building things with timber, well, now you know that the price of timber has gone up, which means the price of running the business is going to go up if they're buying timber. And so then what is that going to do for profits? So that's how you want to start to think about what do you hear out in the world and how does that impact your investments, right? There is a correlation between these things. But continuing to educate yourself, make sure that you're really informed and that you can adjust your strategy as you need. So now let's talk about the call to action, right? So once again, learning is really a great, strong foundation, and continuously learning is super, super important, right? And I've just given you a whole lot of free and low cost and no cost resources that are in the community that you can probably just Google like investing meetings or courses near me and to be able to get more information. But another resource is the National Urban League. It's the National Urban League's Urban Empowerment Fund, which provides education and supports people of color or minority investors. And these are a fantastic resource for you to get started, especially if you're looking for some tailored advice and community support. Check out the upcoming website and for workshops and guides and mentoring opportunities. It's a great way to connect with other investors and learn from experts who understand the unique challenges and opportunities that you might face. But also having an investment club is really, really great. But investing isn't just about making money. It's about building legacy and securing your financial future. And so by leveraging these resources and continuously learning, you can take control of your financial destiny. If you're hearing all of this, maybe you feeling excited but not 100% confident about moving forward, here are a couple of starting points. If you have a 401k, start with reading your quarterly or annual statements of your 401k. Start following the stocks that are in your 401k. And if you don't know what they are, ask your administrator to help get you in that information. Once again, start with an investing simulator. That's what I did. There are free platforms online that let you act like you have an investment portfolio and you can review stocks and make choices without losing any real money. What's great about that is that you can figure out what your investing tolerance is, understand market fluctuations, but also begin a cadence of monitoring your investments. So here's my call to action. Review your investments, set up a monthly reminder to review your portfolio and make adjustments, educate yourself, pick one book or online course, and commit to learning something about investing every single month. Dedicate some time, put it on your calendar. and do it with a friend. And then finally, explore some of the resources that I've shared with you, or go to your local librarian. So that's it for this episode on understanding the stock market. I hope you found these tips and the resources helpful, and that you're really feeling inspired to take control of your financial future. Well, this wraps up another episode of Do Different Better with your host, Elaine Rasmussen. In this beginner-friendly episode, we covered the basis of the stock market, what stocks are, and how the stock market fluctuates. And we gave you an overview of major stock exchanges, such as the New York Stock Exchange and NASDAQ. I also talked about why investing in stocks is a great way to grow your wealth over time, and gave you some practical tips on setting goals, opening an account, and reviewing your portfolio on a regular basis. So this week was about stocks. Next week, you guessed it, it's bonds. I'll break down what bonds are, how they work, and the different types you can invest in, from government to corporate. We'll talk about how they provide a steady income, they preserve your capital, and diversify your investment portfolio. We'll also compare stocks and bonds, and I'll guide you through the process of buying bonds with some practical tips. I can't wait for next week's conversation. Join me in the next episode when we continue your wealth education journey. See you next week, and I'll show you how to do different better. Let me know what you think of the show. We love comments. So tell us how this helped you. If there's a money or finance question you have, or if there's someone you want me to interview, hit me up on LinkedIn or Instagram. And don't forget to hit the subscribe button and follow us on our socials. See you next time.